The S&P 500 and the Nasdaq Composite have reached new all-time highs again. Wall Street has just rewritten its own record. Were you inside when this happened? Because if you weren't, you missed out. And what you missed today is nothing compared to what you will continue to miss if you don't understand what I'm going to show you here. So stay until the end, because there is one thing about the artificial intelligence bubble that no one is saying out loud right now. And this changes everything about how you need to be positioned in this market. But before anything else, I want to extend a 100% free invitation to you. In case you don't know, or if you don't follow me on Instagram yet, I am Brazilian, and on Tuesday, May 4th, I will start teaching how to invest in the Brazilian market, even if you live outside of Brazil. Here, fixed income yields over 14% per year. Many foreigners invest in Brazil, in case you didn't know. We have good energy stocks that pay dividends and our real estate funds, which pay more than 1% in dividends per month. It is by investing in Brazil that I am able to take international trips, like the photos on my Instagram. If you're interested, just click the subscribe button and I will teach you. And don't forget to leave a like, it helps me a lot. So let's get to the video. In recent days, Wall Street has made headlines around the world. The S&P 500, an index that tracks the 500 largest companies in the United States, has broken its own historical record. The Nasdaq Composite, dominated by the biggest names in the technology sector, did the same. And there is a force pushing both of them upwards now, the race for artificial intelligence. nvidia, Microsoft, Meta, Amazon, all clearing hundreds of billions of dollars on the same bet. But before you do anything, buy, sell, or stand still, you need to understand what is really happening here. The financial crisis of 2008, the pandemic crash in 2020, the fall of inflation in 2022, the market plummeted. It scared everyone. Millions of people sold everything. And then it went up again, every time. This is not luck, it's structure. The S&P 500 has an average historical return of about 10% per year over the last century. This is not my projection, it's documented history. If you had invested $10,000 in an S&P 500 index fund 20 years ago without touching it, without panicking, without trying to time the market, you would have more than $67,000 today, just from the effect of compound interest. This is called time in the market, and it is more powerful than any prediction that any TV analyst will make. Now comes the part that most people completely ignore. Investing for the long term is not passive patience, it is active strategy. Do you know what the biggest threat to your portfolio is? It's not a crash, it's not inflation, not even the Federal Reserve, it's you. Dalbar, one of the leading financial analysis firms in the United States, has tracked investor behavior for 30 years. From 1993 to 2023, the S&P 500 returned an average of 10.19% per year. The average investor, 6.81%. Same market, completely different results. The difference was not in the stocks, it was in the behavior. Buying at the top, selling at the bottom, chasing headlines, trying to time the market perfectly. Those who stayed won. First, compound growth. You don't just earn on what you invested. You earn on everything you've earned before. This is exponential, not linear. Einstein would have called it the eighth wonder of the world. The mathematics confirms it. Second, risk dilution. The longer your time horizon, the less any drop matters. A brutal 30% drop seems terrifying in the second year. In the 20th, it's just a line on the graph. Third, operational cost. Those who trade a lot pay a lot. Brokerage, spread, short-term capital gains tax. Every dollar lost in fees is a dollar that stopped compounding. Those who buy and hold keep that money working. This is not theory. It's what the data shows, consistently across all major markets. Sure, here is what I promised. Artificial intelligence is inflating the Nasdaq. That's what the numbers show. nvidia alone surpassed $3 trillion in market value. The technology sector represents over 30% of the S&P 500 today, the highest concentration in decades. Is this a bubble? Maybe. No one knows for sure, and anyone who claims to know is selling you something. But here's what history really shows. The dot-com bubble in 2000 destroyed trillions. Amazon lost 94% of its value between 2000 and 2001. Companies like Pets.com simply ceased to exist. But those who bought Amazon in 2002 and held on multiplied their money more than 200 times. The correction is real. The recovery is also real. The difference between investors who get destroyed in a bubble and those who come out the other side richer is just one thing. Two, in fact, diversification and time horizon. Do not concentrate your entire portfolio in a single sector. Do not invest money that you will need in the next 2 or 3 years. And never use leverage on a long-term thesis. That's how people blow up their accounts. This is not pessimism, it is adult risk management. Bubble or not, solidly based investors survive and continue to compound. Strategyless speculators get swept away and blame the market. So what do you do with all this? 3 steps. Simple. Actionable today. First, before anything else, build your emergency fund. 3 to 6 months of expenses in high liquidity, low risk assets. Without this reserve, any market downturn will force you to sell at the wrong time. It's this mistake that ends most investment journeys before they truly begin. Second, expose your portfolio to the S&P 500 through low-cost index funds or ETFs. SPY and VOO track the S&P 500. QQQ tracks the Nasdaq 100. All available at any brokerage, Fidelity, Schwab, Vanguard, Robinhood. If you have a 401k or a Roth IRA, this is exactly where these vehicles shine. Compound growth with tax advantages over decades. Third, invest on a fixed schedule. The same amount every month, regardless of whether the market has gone up or down. This is called dollar cost averaging. It eliminates the trap of trying to time the market. It is academically proven to reduce the impact of volatility over time. You don't need the perfect moment. You need the longest possible time horizon. That's the differentiator that most people never use because it's boring. And boring is what truly builds wealth. Oh, the S&P 500 has hit a record. The Nasdaq has hit a record. And it will keep hitting records, with drops along the way, with real crises, with bubbles that will appear and burst. The question has never been how to avoid the storm. It has always been about building the right boat before it arrives.